Hey, hi everyone. Welcome to another video in our hedge fund series. So today we are going to discuss about AI and ML models, and we are going to discuss about predictive AI models, and which are used in the hedge fund industry. And we are going to discuss about only the top few ones that are used by the hedge fund industry for prediction of stock prices and option movements, and also for forecasting. So the top. So first, what we will do as a part of this video is we will go through an English version of all these models, which is basic explanation of these complex mathematical models in plain English terms, and then we will go into a detailed version of these same models, where we'll go into more details rather than a plain simple explanation of these models. So first model that we will talk about is linear and logistic regression. So what this particular thing does is it tries to find relationship between two things, like for example the past price and the tomorrow's price. So it tries to find a relationship between those two. Regression is basically you take two parameters and you try to find the relationship between those two parameters, and there is something called as a correlation coefficient. If correlation coefficient is 1, means if one thing goes up, the other will go up. So that's what it is. And linear regression is basically extrapolating the past data to predict the future. And when the correlation coefficient is 1, then basically those two parameters basically have you know same moment, or if one goes up, the other will go up. One goes down, the other will go down. So in these regression models, what we will do is we will look at the relationship between things like past price and tomorrow's price. We will try to see the relationship between these two, and the model, what it does is it looks at the past price and tries to predict the tomorrow's price. And it is basically whether it will go up or down. That's the only prediction. So whether it will go up or down is a prediction, and that's what this model is used for. Okay, so that's a linear and regression logistic regression model. Then we have decision trees and random forest. So decision tree is like a decision tree basically, where you one if you have to take a decision, any decision that may involve an investment decision or a buying decision. You will go through certain small decisions that lead to a big one. Okay. So like if you want to buy a house, right? So then first of all, first thing you'll ask is, where do I need to buy it? So that is a small decision. What is my budget? That is the next small decision. Then how many square yards are you okay to buy? Do you want to buy a pre built one, or you want to build on your own? So these are all small decisions that you'll go through to come up with that major decision, which is the big one. And this is what is a decision tree. So decision tree, what it does is it maps out your small decisions that lead to a big one. And it will have like yes or no flows, where based on a certain flow you will come to a particular decision. That's what a decision tree is. And random forests are a very you know uh, basically decision tree at scale. The decision trees done with a lot of parameters. It's nothing but a random forest with a lot of outcomes and a lot of parameters, is what a random forest is. So yeah, so it's basically asking yes or no questions to arrive at a decision. Many small decisions will lead you to a bigger one, and those small decision trees you will navigate to come to the bigger decision. Okay, this basically, what is the use of this particular model is it tells us whether it's a good time to buy or sell based on conditions. Okay, so example, volume and RSI. So if the RSI is the volume is high, you may say that let's buy it. So that is one decision tree. And if RSI is above 60, let's buy it, or like that. So that sort of decision, small decisions, will lead to a bigger decision basically. And random forest will involve a lot of other parameters, multiple parameters to come to a decision, is what a random forest is. So then we have XGBoost and Light GPM. These are the other AI models for prediction. So this is nothing but a supercharged version of decision trees, the XGBoost and Light GM. But what it does is it's not just a complex version of decision trees with multiple parameters, but it can learn and from its mistakes, so, and improve the predictions. So that's what the specialty of these models are, that they can learn from their mistakes and improve the predictions. So that the models have the learning capability like humans have. They can learn from the mistakes and improve the predictions. And these models, XGBoost and Light GBM, can be used for predicting short-term price movements, or which stock might outperform. Then we have long short-term memory, LSTMs. These are called long and short-term memory. So this is a deep type of deep learning model that remembers patterns over time, like how people notice trends in prices. So this is like more like a technical analysis where people find all these patterns, right? Head and shoulders, inverted head and shoulders, and flags, pendants, and whatnot, cup and handles. So these are all patterns, right? And or a price action, uh, or upward price action or downward price action, so higher highs, higher lows, or lower, so which indicates a upper uptrend. So such these are basically patterns, or candlestick patterns, or also patterns. So these are all patterns. I'm only talking of technical patterns, but patterns could be even a chart patterns also. Like if chart is moving in a certain way, uh, that also could be a pattern, right? So these models, what they'll do is they'll remember these patterns over time, and then based on it will learn what these patterns are doing. And this is what humans also do. Humans also deploy this, and in trading basically we are forecasting and we are predicting, and we use certain patterns to predict, for suppose some pattern could be, which is widely used, is RSI above 60, take a long position, or above 200 EMA, it is a bullish. So these are all patterns, but and these are fundamental patterns. These are also technical patterns. Okay, fundamental patterns could be like, if a particular stock is giving return on equity very high, above 30%, or return on investment is very high, and its growth rate is very high, and its cost consumption is very less, and it has a very good future potential. So that's a pattern. Okay, so these models, the short term memory, are pretty similar to human beings. They do this deep learning, and they remember patterns over time, like how people do. And this is used to predict the future stock prices based on historical trends, like what might happen after 10 days of gains. Okay, so this is used for forecasting or prediction based on historical trends. Then we have CNN, which stands for convolutional neural networks. So what it does is it recognizes images. So here it finds, so you can give a chart to it, and it finds patterns in that chart, and the price movements in the chart. And this is used, like technical patterns like breakouts, double bottoms, all this it can find. So it can look at the chart, and it can find patterns in the chart, like support, resistance, or breakouts it can find in that, double bottoms it can find in that, and based on that it can predict the future, similar to what humans do by reading the charts. The chartists do by reading the charts to predict the future. Then we have something new, which is transformers, and there are different models in this, BERT and FinBERT. So these transformers, what they do is they read financial news or tweets, and tell whether the mood is positive or negative. So the sentiment of the market based on the information or the news. So these models read, and they tell, whether the mood is positive or negative. And if the mood is positive, then the stock will move up. Or the mood is negative, the stock will move down. So market sentiment based on news and information is used to predict the stock movement by using these transformers. Okay, then we have reinforcement learning. So reinforcement learning is This what these models do is they learn by trial and error, like a video game player who gets better with each try. So these AI trading bots learn what works best over time. So they'll do something again and again, like a new trader does something and he learns from his mistakes, then does something and learns from his mistakes, like not to do over trading, and so on, right? Have risk management, have strategies in place. So the model also learns similarly, and it improves by learning from its mistakes, and by doing a trial and error method. This is called as reinforcement learning models. Then we have Arima Sarima AI models. So these models look at the past numbers and predict the next numbers, like sales or stock prices. And so this is all numbers based. Certain patterns, past numbers are looked at and to predict the next numbers. This is good for short-term forecasting, like predicting weekly price trends. Okay, then we have support vector machines. So support vector machines is another model we have. And what this does is it draws boundaries to separate things, like drawing a line between a buy and a sell. Okay, so these models could be like great for making directional calls. So it's like having uh, like a 200 EM, and if it goes above, let's buy it, and if it goes below, let's sell it. So some lines are drawn to separate things, and yeah, between a buy and a sell. It's used for making directional calls whether the stock will go up or down. Like if it reaches the support, also you draw support and resistance lines, and if it reaches support, you assume that the price will go up from there, and if it reaches resistance, it will come down from there. So such similar things are done by these models, drawing a boundary to separate things, and taking decisions based on those lines drawn. Ensemble models. So these combine predictions from all many models to make one smarter decision. This increases accuracy by reducing the chances of one model making a mistake. So this is a combinatory model that takes advantages of all the models, try to make the prediction better. All these models, what they basically do is they learn from the past data. So they take the data of price, volume, indicators, news. That's past data they'll trade, and they'll find patterns or trends in that data. Like the patterns could be, for example, when RSI is low, volume is high, prices goes up. Or the pattern could be, when above 200 EMA the price goes up on a daily chart. That sort of patterns it finds, all these models, and then it makes a future guess, a forecast. Like this is a chance for the probability of this particular thing to rise tomorrow. Okay. So all in all, if we see these models, regression is used to predict whether the prices will go up or down. Tree based is, when it will tell you that when to buy or sell, and LSTM will follow the trend or spot reversals in chart. So following the trend or spot reversal can be done by LSTM models. And the transformers, you can read the news and get a sentiment if it's good or bad, and put good buy position, bad sell position. Reinforcement is training a robot to trade smarter with experience. So some real examples of these models are, yeah, in India, predict Nifty option expiry moves using LSTM, long short term memory, or XG boost. That's a real example. In the US, this Finbert, which is a transformer model, is used to analyze Tesla earning calls and predict stock reaction. Okay, so these are all the AI and ML models, and we went through the famous ones. So let's go deeper into these models and understand them in a deeper way also, not only in plain English and easy to understand language. Okay, so yeah, the linear and logistic regression. It is finding the relationship between two parameters and using historical data to predict the future price. So it's a baseline model for price prediction, and what it does is it basically tells predicts next day returns, and binary classification, buy or sell, it gives you. And it's commonly used for forecasting the Nifty, S&P 500, and stock movements. Simple, fast, and interpretable. So these models are random forest and gradient boosting machines. So These predict the stock returns on price direction, so using volume moving averages, RSI. So this is looking at the direction of the price, and then predicting the future based on the pricing direction. And certain other parameters like volume moving averages, RSI, also it uses to do the prediction. And it handles non-linearity, and okay, and features importance ranking is also it can handle. And application of this particular models is options volatility forecasting and earning based moves. These models can be used for long-term, short-term memory networks. So LSTMs are deep learning recurrent neural networks, and these are time series forecasting of stock prices or volatility. These are used for. The advantage of these is they capture long-term dependencies and trends in sequential data, and they are used for predicting Nifty 50 movement based on 20-day history, earning cycles, etc. Convolutional neural networks, which is CNN, these do pattern recognition or candlestick images or sequences, and they use they can be combined with long short term memory for price patterns, and then pattern learning, convolutional LSTMs. And these do is, from the images they can detect breakouts, or they could detect certain chart patterns like cup and handle, head and shoulders, like that. These things can detect. So convolutional neural networks could do some sort of technical analysis for us, in short. Okay. Then we have transform models. So these models basically predict market sentiment from financial news, tweets, earning transcripts, and yeah. So this is they are able to get the sentiment of the market based on news. So yeah, they basically look at the financial news, tweets, earning transcripts, and information, and to predict the sentiment of the market, and make a decision based on that. So this predict impact of news on stock prices using news flow. Reinforcement learning. So these are optimal trading strategies via simulated environments. Models learn these optimal trading strategies via simulated environments. This could be used for on Indian stocks also. Popular frameworks in these are reinforcement learning models are Tensor Trade, FinRL, and Jim Any Trading. Autoencoders and anomaly detection models. These detect unusual price movements like pump and dump, or very unusual movement from the main. So these are able to detect that option price spikes pre-expiry or before earnings. They can be applied to use for. And bonus is this is used for fraud detection in algorithm trading logs. ARIMA statistical models. These are statistical models. Series modeling. The use of these models is for time series modeling for short-term price forecasts. They're able to predict bank nifty weekly expiry moves. Support vector machines. Classification of bullish and bearish trends can be done by these models. High accuracy in a narrow range bond markets, sideways, ITC, or SPI. Ensemble and stacked models learning. So combine multiple models like LSTM, GBM, ARIMA for improved predictions. This is a multi-layer forecast engine for high conviction options trades. So these are all the different AI models we have, and you know we learned a plain English version of these models, and also a detailed deep dive of what these models are, and what their use are and applications are. Yeah, and these are used in hedge funds also to forecast the prices. And even in a normal trading, we use certain patterns to forecast or do trading. And everybody, when they are doing trading, they are taking some information, processing it, and forecasting something. So here, what AI is doing is AI is helping us to do the same with certain mathematical frameworks and mathematical models. Yeah, that's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye. Hey, hi everyone. Welcome to another video in our predictive AI models series. Today we are going to discuss about transformers, AI models, which are used in LLM, language learning models. But these models are now being used in trading as well as in trading for predictive modeling. And they have very impressive backtest results. And we will go through specific examples of these backtest results as a part of the video today. So, what are these transformers? Transformers are a set of AI models originally developed for language tasks. Uh, these models basically what they do is they go through the in a sentence. Basically, once you give it an input data, it goes through the basically the words or certain sentence patterns that weigh more and that matter more, and then it will predict the future words or the sentences in the language learning models. That's what these transformers are, and these transformers, which are a class of AI models which are used in language tasks, are now being used in finance also, and they are making waves in the financial markets for predictive modeling. Okay. So, what is the basic advantage that you will get when you use transformers in trading? Is the first thing is structure. So, what these transformers do is they use something called as an attention mechanism to identify and weigh relationships between different pieces of data. So, example, if you give it a past price movement to it, then it will itself identify which part of this entire past price movement data that we have given weighs more, and it finds the relationships between the different pieces of past data that we have given it, and this is done through something called as an attention mechanism. Okay, the second thing is the purpose. Why we are using transformers is, the purpose is these transformers don't, instead of treating each point equally, each data point of the previous past prices equally, what they do is they learn which events or, the matter most for future predictions. So they are able to identify the events that matter most for the future predictions, and it has an edge also. So that's why they are using this transformers in trading. These transformers are able to handle long-term dependencies and complex patterns more flexibly than traditional models like LSTM, which stands for long short-term memory trading AI model. So these have an edge, these transformer AI models in trading, and the basic main things are, attention mechanism to identify and weigh the relationships between different pieces of data. That's the main thing, and the data that we give it to is the past price movement data. And the other thing is it doesn't give equal importance to all the price movement data. It is able to find, which data is more important, and that can be used for future predictions, and it can also analyze, it's flexible enough to analyze complex patterns also, and long term data also it is able to analyze. So that's the reason these transformers are finding use in trading. Okay. So, why these transformer AI models matter in financial markets are the main use cases or advantage that we get out of these transformer AI models are capturing long-term trends. So these models are very good at capturing long-term trends. They can track patterns over weeks or months, and this is very good in, in a trending market or slowly moving trading scenarios. So they're very good at capturing long-term trends. That's the first advantage these models give us. Second thing is integrate textual data. So what these models can do is, some models are there in this transformers like Finbert. That is a transformer trained on a financial text. Okay, and what these Finbert can do is, it can give a sentiment based on news headlines, tweets to the pricing models. So sentiment can be given based on some analyzing the textual text data, financial text data from financial news headlines, tweets to the pricing models. So that is the main advantage in integrating the textual data and doing a sentimental analysis and giving it to the pricing models, apart from capturing the long term trends. The third thing is it can adapt very quickly. Transformers can automatically recalibrate these attention weights when markets shift. Okay, so it has this attention mechanism, right? It is able to identify which particular price movement in the past is very important for prediction. So once the data changes, it can recalibrate itself and learn itself, the new attention uh, data or mechanism data that can be used for predictive modeling. So some of the real world backtests of these transformers are, the one is quantformer. So this quantformer was done on China equities. The setup was around 4.6k stocks across 10 years of data was basically taken in Chinese market, equities market, and given to quantformer, which is a transformer again, AI model. And what it did is, when it the predictive modeling of these particular transformer is, it outperformed 100 standard factor based models in predicting, and the returns are better than 100 standard factor based models, and with low turnover. So that's the result that was found when it was tested on 4.6k stocks across 10 years of data in Chinese equities market. What this demonstrates is the ability to detect sentiment influenced signals, and to improve the forecasting. Okay. The second thing is day trading strategy on Middle East stocks is also done. So here the method is a combination of transformers and technical indicators was used in this particular back testing, and profit target was based on the risk. So that was what the back testing was done. So transformers plus technical indicators on and on Middle East stocks, and target is based on the profit target is based on the risk. The results of these particular backtest results are, it delivered consistent profits when targets were modest, like 1.5 or 3.5 of the risk, and it significantly outperformed the buy and hold strategy. The other example is momentum transfer in equities and futures. So, approach was a hybrid of attention mechanisms and LSTMs. So here, the transformers plus long, short-term memories, both models are used here, and in the equities and futures market. And this performance averaged 4.1% returns, but the Sharp ratio was one is to one S&P style trading, compatible to traditional momentum strategies. So even in the momentum strategies, it is outperforming the traditional momentum strategies, and even in the day trading strategies also, it's outperforming the buy and hold strategies when the risk to reward is properly managed, and it outperformed over 10 years of data also in the Chinese market, and the 100 standard factor models. The other thing is high frequency Bitcoin HFT. This was another backtest done. The model is HF former, tailored for ultra short time frames. So HFT is high frequency trading, that too in Bitcoin. So this is for ultra short time frames, and transformers are used. The transformer name is HF former, basically high frequency trading transformer, short form of that. Outcome of this particular thing is, it achieved high cumulative profit than the LSTM based models during the back testing. Okay, so this transformers is a new thing happening in AI, and it's giving very good results compared to the even the traditional LSTM models, or the traditional momentum models, or the day trading models. When backtested on certain um, on the Chinese market, the Middle East stocks and futures, and high frequency Bitcoin trading. So yeah, combining transformers with other techniques is also giving good results. Like in one example, we have seen that transformer was combined with LSTM. So combining memory from LSTMs with the attention from transformers is improving the accuracy and consistency. That is one of the key things that's happening in this AI trading models and sentiment models. So transformer is very this is its speciality, having able to read the text and find the sentiment from the text. So pairing this Finbert, which goes through all the financial news, tweets, and all that, and able to find the sentiment with structured models is enhancing the prediction accuracy of the stock movements. So how traders use transformers today? It's signal generation. So basically predicting next day moves, intraday high lows and volatility spikes. So signals, for signal generation they are using, and sentiment overlay, combining the market outlook from news with technical signals for better insights. And so sentiment they are able to combine it with their technical analysis or fundamental analysis by uh, and able to trade based on that. HFT applications also it's being used for, so it is able to exploit micro inefficiencies in high frequency markets. Hybrid evaluation, a combination of LSTM and attention layers, is also improving the predictive accuracy of these models. So the final takeaways of transformers is, transformers excel at spotting long term trends and finding the sentiments from the text, and they are context rich patterns also. So that is what they excel at. And they're good at finding which piece of data is more important, and which piece of data weighs more or is more important for predicting the future. Okay. And they can even analyze the text also, that is their specialty. If you see, if they're combined with some technical indicators, LSTMs, or on their own also, they're able to generate very good returns compared to the traditional models. That's why there is a new wave that these transformers are going to be more useful in getting good returns in the financial markets. And this is all AI, so this is all cutting edge that's happening right now in the market. So backtests are very good. If you see, I've gone through these Chinese equities and the Bitcoin HFT. They basically show that improved returns are there when risk is properly adjusted. And due to these reasons, adoption. Right now, the adoption is only in academic and internal pilot stages. Commercial tools and codes are still emerging, and they require some specialized expertise. But this is a thing that's happening, and it's promising basically. And if it is able to live up to its backtest data in the actual world also, this will basically improve the returns. Okay. Yeah. So yeah, all in all, what these transformers are doing is they are bringing language grade intelligence to financial forecasting, and good exciting results are coming across multiple markets and time frames. Okay, so that's the final takeaway, and it's outperforming major traditional LSTM models also, as well as the traditional momentum strategies also in a few of the examples. So that's the transformers for you guys today. So that's a new AI model that is in the back testing done on Chinese markets, Middle East stocks and equities and BTC. It has outperformed and provided consistent results, and is able to capture long-term trends and find sentiments from textual data. And something it has is attention mechanism and identifying which pieces of information are more important, and it's basically performing better than LSTM models. So yeah, that's about transformers, the AI models that are being used in financial markets for trading. Thanks everyone for joining the call. Have a nice day. In trading at intraday positional and swing trading levels, and how whether hedge funds use this, and brief details about harmonics history, who invented them, and how successful is this strategy, what returns are generated by this strategy with specific examples. Harmonic strategy, basically, the inventor of this one is H.M. Gartley. 1932, he introduced the first harmonic pattern known as the Gartley 222 in his book Profits in the Stock Market. And after that, Larry Pesavento later enhanced this Gartley's work, applying precise Fibonacci ratios to pattern recognition. Then Scott Carney formalized this discipline in the 2000s, popularizing patterns like bat, crab, shark, butterfly, and the 5 0, complete with detailed trading rules and risk controls. So core concepts and mechanics of harmonic patterns are it's based on Fibonacci retracements and extensions, and these harmonic patterns identify geometric price structures. Example: AB equal to CD, Gartley, bat, crab, butterfly, and shark. So these are geometric price structures. These patterns basically specify entry zones. For example, D point of PRZ, and they also not only specify the entry point, they also specify the stop loss and profit targets points also, making them more objective than many chart techniques. These are also considered leading indicators, and they anticipate reversals before they occur. So these patterns are leading indicators, and they can anticipate reversals before they occur. How you can use harmonic patterns to trade across time frames intraday? You can apply these harmonic patterns on 5 to 15-minute charts to detect short-term reversals at harmonic PRZs. Swing and positional trading, you can this can be used on hourly or daily chart to catch multi-leg reversals like wave CD in Gartley and crab. Hedge funds and professional use, institutional quants occasionally incorporate these harmonic structures as filters or timing overlays, though most remain proprietary and non-public. How hedge funds or institutions use these harmonic patterns is proprietary and it's not public. Performance of these harmonic patterns and real-world examples are, bad pattern when it was backtested in April 2024, it showed consistent positive returns with clear entry and exit rules. Sharp pattern in April 2024 again provided defined risk reward zones and repeatable setups across assets. Forex traders regularly use this high probability reversals, though accuracy depends heavily on precise pattern detection and confirmation. Some trading communities claim 300% annual returns, but these are anecdotal and require disciplined execution. So the strengths and weaknesses of harmonic patterns are it's objective, clear entry exit planning is done via Fibonacci based rules. It works across all markets and time frames, and it enables high risk reward setups with the measured stops and targets. Suitable across different trading styles, you can use it for intraday swing and positional. Weaknesses are it's highly technical, and it requires precise labeling to avoid false signals. Yeah, identification is subjective and often needs specialized tools and software. In TradingView, we have a tool, which automatically draws these harmonic patterns. I'll show that to you. Overlapping patterns can create confusion and reduce clarity. Okay, yeah, if two patterns are formed at the same time, which are contradictory, that could create confusion and reduce clarity. In that case, we should not trade, right? Yeah, but that's a weakness. And success demands a discipline, patience, and often tool based scanning. So, example of a strategy which you can deploy by using harmonics workflow is you spot potential pattern a crab, a bat, or XABC swings forming a valid structure like bat or got like you first spot it. There are tools which can automatically spot them in TradingView, and you confirm this with Fibonacci. You can deploy the Fibonacci retracement and extensions to match these pattern specs. Automatic Fibonacci retracement and extension is also there in TradingView. We can use that and plan entry at the entry point basically, and put a stop loss beyond the pivot, and set profit targets partial at 38-61% retracements, uh, a full at points your deep extension. Okay, you can add filters further other than harmonics, just using by themselves. You can add certain other filters like RSA, momentum indicator, and MACD, or volume, to confirm trend, some trend indicators, momentum indicators, and volume to confirm the signal that is given, or to enhance the probability of success of the signal that is given. and manage trade. Then once you succeed, you scale this, put trail stops and exits on invalidation. Okay. So this is a harmonic trading strategy. It leverages precise rule-based pattern recognition with Fibonacci controls, offering you know potentially high reward trades. Okay, and clear entry exit conditions are there as a purely technical indicator. And some back tests on Batman and Shark has produced favorable results. But again, it should be added with some other filters and back tested properly and then used in real trading. So let's see how this bat and harmonic patterns look like. So this is the indicator you can use in trading view. This is called harmonics. So yeah, so if I enable this, yeah, so see this, if this is a harmonics, you can enable this. There are multiple indicators, but this is the one I've used. There are other indicators also in harmonics, like auto harmonics is also there. Like if you go to yeah, so this harmonics is enabled. Let's see, chart is refreshing. Not sure where is the harmonic found here. Yeah, so see here, I'll remove the other ones so that we know clearly. So see here, basically it says what is the pattern that is formed. So this is a bearish shark, and it has success. This prediction, whatever has come that it will go up, has is a success basically. So if it's a success, it will put a green. If it's a failure, it will put a black one. Okay, a red one that it failed. So this is a bearish shark, and you see here. So this is also a bearish shark signal that got generated, and target has been hit. And again, it's now giving a new potential bearish shark. Okay, so yeah, like that signals will get generated, and yeah, let us see. So if we do this, so this is clear right now. So if you see this, this is a bearish shark, and this is a bearish cipher. Okay, it puts even targets and stop losses also. So if you see here, it has plotted the stop loss and the target also. So that's how it is helpful. Other indicators are also there, like we have if you put harmonic patterns, harmonic patterns. If you put yeah, nothing is coming. Yeah, there is an automatic harmonic pattern also. Like auto. If you put auto. Yeah, so like this, you have auto harmonic patterns from trendoscope you have. So you can use these, and that's what these will do basically. And they will give you the signals. It's a prediction tool which you can use to predict. Okay, yeah. So that's the harmonics for today, guys. So thanks everyone for joining the call. So this is a precise technical tools which uses Fibonacci and certain geometric price patterns, and which have a high probability you know reversal, and they have also consistently performed better in some back tests, and it can be used for forecasting. So thanks everyone for joining the call. Have a nice day. Bye. Hey, hi everyone. Welcome to another video in our AI predictive models series. So today we are going to go through reinforcement AI models and how this could be used for predictive modeling in trading. And we'll go through some of the examples where these models have performed better than the traditional models, and specific examples we'll go through, and the details of those specific examples we'll go through. Okay, so reinforcement learning models. So what are these? So this is basically oral agents or reinforcement learning agents learn to trade by taking actions. So like a human being, we learn trading, right? So initially you trade, and you will try to see how your strategy is performing, and in different various market conditions. When it's bullish, how it's performing; when it's bearish, how it's performing; when it's sideways, how it's performing, and again during different time frames of its performing, and so on. So that's how a human being will learn, right? But he learns by doing things, and even failing, and identifying those patterns, right? So similarly, reinforcement learning agents learn to trade by taking actions. So it basically it trades actions like it does a buy, sell, or a hold in a simulated environment. It does. We do it in the live environment, but this reinforcement learning agents do it in a simulated environment, and the main goal is to maximize cumulative rewards of the profit, which is even a human being's goal also. At the end of the day, we also want to maximize our cumulative rewards of profit. Okay, so that's what these do. So these behave pretty much like humans, but um, like trial and error method, it can be analog, that could be an analogy to what RL agents are doing. At the same time, learning mechanisms which human brain generally uses. So it's similar to that. So it learns by doing things, and okay, and with a goal in mind. Okay, and that's what it does, and that's what these RL agents are. They learn to trade by taking actions in a simulated environment. They do in a simulated environment. In real environment, again, things could be a little different to simulated environment, because the real environment has emotions in it. But again, agents don't have any emotions, so they perform pretty much same, even in the simulated as well as in the real environment. Okay, so unlike other prediction models, this ARL reinforcement learning model learns how to behave under different market states through trial and error. So when we say different market states, it could be referred to, right, bullish state, bearish state, or a sideways state. Okay, so it learns how to behave through different market states through trial and error. Okay, if you want to set up these reinforcement learning prediction models, okay, what we need to do is first we need to define the environment. Which is we based on price data, technical indicators, and possibly sentiment. We need to give all the data to the reinforcement learning models: the price data, the technical indicators data, and the sentiment data. Then agent observes the state. Okay, so it observes this state and chooses some action. Okay, it takes either a long position or a short position, and it receives a reward, either a profit or a loss it will receive, and then it transitions to a new state. So such this is how it will learn, based on the data we'll give of the price indicator and sentiment. It basically observe that data and take an action and receive a reward. Okay, then we need to choose, once you set up all this, then we need to choose an RL algorithm, which is deep queue network is one algorithm, DQN it is called. It what is the does is discrete actions. Uh, the model is able to do discrete actions basically, like long and short is a discrete action. Long is one discrete action, short is one discrete action. SSE, PPO, DDPG, these are this is another algorithm. Continuous or discrete actions with policy gradient methods. So again, this is also a discrete action, but continuously it will do it. Okay, actor critic. This is another RL algorithm. It combines value function and policy learning. So basically, these will learn the patterns, or not patterns, but different states. Okay, different states it will learn, and in those states, through trial and error, it will know what worked and what did not work. Okay, so that's what it will know. So once this RL algorithms the setup, the environment is set up, then you can train and backtest that. You simulate trading over historical data, and basically see the results, and you can adapt, do some changes to the engine to improve the performance. Yeah, coming to the performance highlights, SSC versus Dow Jones. So SSC, that's a reinforcement learning model, outperformed the Dow. Okay, in bull market 2020 to 21, SSC has bet the benchmark returns. So it gave more returns than the benchmark. In downtown 2022 also, SSC dropped only 5%, minus 5% basically, and Dow was minus 13% during that time. So it's better two times than the Dow. DRL for cryptocurrency. DRL is again another reinforcement learning AI model, deep reinforcement learning model for cryptocurrency. When it was tested, a study was done on it. A study on 10 cryptos was done using DRL model. So after mitigating overfitting, DRL agents outperformed the equal weight and the market benchmarks. So again, it bet market benchmarks, and even across two crashes also it outperformed the market. Okay, so it working both in the bull as well as the bear market. That's the beauty of it. Cascaded LSTM plus DRL model. LSTM is long short-term memory, and DRL is deep reinforcement learning model. So when it was applied to US Dow Jones Index and China's SSE 50, it surpassed baseline models on both cumulative return and Sharpe ratio. So it's outperforming the benchmark, that's for sure. Okay, and even it's working both in bull and bearish markets also. Futures trading, when it was done with DRL, so using DQN and PPO agents on 50 futures from 2011 to 19, it outperformed trend following strategies even after trading costs. After trading costs also, it outperformed the trend following strategies. So it is uh, doing good even in trend following strategies also. Alpha stock, so attention based reinforcement learning models. So interpretable RL for buying winners and selling losers. So this is stock picking basically done by AI. So reinforcement learning models can do stock picking also, and it could identify the winners and sell the losers also. And it was effective across US and China markets, balancing the risk and return. So one of the community Reddit user reported that backtesting the calendar year 2019, Sharpe ratio was 4.2, returns were 86%, maximum drawdown is 6.86% in versus SPY 30.86%. Okay, with this DQN plus LSTM plus CNN models. So the all these three models, reinforcement plus long short-term memory and convolutional neural networks, gave a return of 86.3 percent with a drawdown of only 6%, 6.8%. Another built-in swing trading reinforcement learning bot using indicators and Alpaca experimented with DQN, DDQN, prioritized replay, and seeing progress in live testing. So yeah, so these models, the reinforcement models, are performing better than the index, the normal index, which the passive investing we can say, and at the same time they're working good in both the bullish and the bearish markets, and are good at identifying the trends also. Summary of performance metrics. So if you see SSC on Dow, it outperformed in upside as well as half in drawdown in 2022. DRL crypto 10 coins bet market benchmarks even during two crashes. Cascaded LSTM plus RL best in DJI and SSC 50, higher returns and sharp. Futures 50 contracts bet trend following after cars. Alpha stock RL plus attention, risk balanced performance in US and China markets. Reddit DQN plus LSTM plus CNN 80%, 86% returns with a sharp ratio of 4.2 and MDD of 6.9. User built RL model, active swing trading experiments in live conditions. So why these RL models work? Because they learn from the environment. Like a human being does, they learn. They're adaptable and they're dynamic. They learn from the environment and they adjust the strategies over time. Risk sensitive rewards, so can optimize for sharp ratio or downside protection, not just returns. And strategy diversification, they support long, short, hedge route, portfolio based and cross asset tactics. So that's why these RL models are very good. Challenges are overfitting could be there, so need robust validation. Crypto sample identified and discarded overfitted agents. Regime shifts could be there. Performance decrease if market trends change. Retraining is again essential. Complex reward design. Choosing the right reward function is difficult. One study showed poor results using Sharp directly. Final thoughts basically are RL models from DQ and to SSC have shown impressive backtest performance, often stronger than passive benchmarks. Real world success depends on avoiding overfitting, setting appropriate rewards, and frequent retrading. These methods are gaining traction in crypto, futures, equities, and macro markets. So that's it, guys, on the reinforcement learning models. Thanks everyone for joining the call. Have a nice day. Bye. Everyone, welcome to another video in our AI predictive models. And today we are going to go through ensemble AI models and how these are used in trading and for predictive modeling in trading, and some examples of how these are used, and some impressive backtest results and specific examples that we'll go through. So ensemble AI models, what are these? These are, these combine different predictive algorithms. It's basically a combination of different individual predictive algorithms, and that's what is called ensemble AI model. Um, so, what are the different individual predictive models? It's like LSTM, neural networks, random forest, ARIMA, SVM. So these are all individual or reinforcement learning. These are all individual AI models, predictive models. And this ensemble AI models will combine these multiple predictive algorithms, and it's growing in popularity for trading because it boosts accuracy and reduces bias and adapts better to changing markets. Okay. So yeah, so ensemble models are used in trading, and they blend basically predictions from multiple algorithms. So like LSTM will give one prediction, neural networks, convolutional neural networks will give one prediction, random forest will give one prediction, ARIMA will give one prediction, SVM will give one prediction. So they blend all the predictions from these multiple algorithms and also technical rule-based systems to produce a consolidated and a more reliable forecast. So it's basically getting, think of it like, getting several expert opinions and using their combined wisdom to basically make smarter trading decisions. Yeah. The random forest model, what we did is you put a lot of parameters into it, and yeah, then it becomes, multiple parameters will give you a more a better probable uh, predictive prediction for tomorrow, because multiple factors are put into it, and when all of them together say that this event is going to be most probable, so it will, the probability of that happening is higher. But here what you're doing is, you're not putting multiple factors, you're putting multiple algorithms together, and ensembling them together along with technical indicators, and taking that combined wisdom to improve your trading decision or prediction. So how they work in trading, you basically train each model separately. So one LSTM for temporal patterns, one ARIMA for linear trends, one Bollinger Band script for breakout detection. Like that, you will train each model separately. Then you will combine the outputs. So simple average, a bagging, and a refined boosting, and a sophisticated stat models where outputs feed into meta learner. So what is this bagging, boosting? So let's go through the example. What is this bagging and boosting? So I'll just go through high level what bagging and boosting is in ensemble words. So bagging, if you say, so bagging is, you'll allow multiple models to run parallelly, and then the result will come. Whereas boosting is, you will run one model sequentially, and then the sequential models will basically provide or basically uh, you know making or being used for the output. So that's the difference. So bagging is, multiple models running in parallel and feeding the output, and boosting is each model running sequentially and at the same time boosting the output. So that's what bagging and boosting is. And yeah, let's get back. So yeah, so you basically train each model separately, and then you combine the outputs, simple average, bagging, okay. So running parallelly, all of them, and then a refined boosting method running each one of them sequentially, and a sophisticated stack model where outputs feed into meta learner like XGBoost. So that's what you could use, to combine all these outputs from different models. Then you backtest this ensemble strategy, evaluate in sample and out of sample, and compare to benchmarks. And then if the results are positive, then you deploy and generate live signals, and retrain the model periodically. Some of the backtest examples, performance highlights of this ensemble models are Bollinger plus LSTM ensemble. So this is Bollinger bands plus long short-term memory models together. This ensemble model assets tested is 50 S&P 500 stocks from 2018 to 22. Results were this model was able to generate a CAGR of 6.45% with a Sharpe ratio of 0.49 versus benchmark S&P 100% in market. So the benchmark only provide means was able to generate 4.92% with a Sharpe ratio of 0.43. So it did better than the benchmark. It outperformed both standalone Bollinger as well as the benchmark market also. ARIMA, CNN, LSTM model. So three models are mixed here. ARIMA, CNN, and LSTM hybrid. So the assets tested are Shanghai Index, Bitcoin, and EU ETS credits. Results are hybrid model had lower forecasting errors and better directional accuracy than individual ARIMA, CNN, or LSTM models. And this shows combined models capture linear and non-linear patterns more effectively. So it basically outperformed each individual models and was reduced the forecasting errors, and it was better in terms of directional accuracy. And the next one is LSTM plus random forest combo was used, and application was predicting next day returns based on technical indicators. These results also highly this hybrid outperformed a single LSTM model in error as well as in directional accuracy. Transformer of ensemble agents, so stock and crypto trading task. So this is a transformer AI model, and ensemble agents achieve higher returns and better sharp and lower drawdown than single agent models. Stock classifier ensemble, so assets or US stocks 2011 to 19 methods are combining the naive base decision tree logistic regression and SGD. So all those four AI models are combined together: naive Bayes, decision tree, logistic regression, and SGD. We'll go through naive Bayes model also in detail in one of the videos. So it generated 54.35% over 8 years. Meta learner stacking. So this model combined ensemble model combined LSTM, GRU, CNN with XG boost meta learner. It achieved 7% MSC reduction and 3.5% improved accuracy, and a map of 2.24%. Why ensembles work basically? That they reduce overfitting and bias. Errors from one model can be offsetted by the other model, and yeah, capturing the diverse patterns. So ARIMA could be used for trend, CNN for spatial features, LSTM for sequence memory. So we could use the best of all the models, and yeah, adaptive. It performs performance weighing adjusts as market conditions evolve. Limitations are it's complex, so more hyperparameters are there, so model tuning is required. Computation power is more, training time will be more, overfitting risk is there. Okay, so we need to see some cross validation and auto sample testing. Again, summary is Bollinger plus LSTM ensemble on S&P 500 between 2018 and 22 had a CAGR of 6.45 versus the benchmark of 4.92. ARIMA and CNN LSTM hybrid on indices BTC and EU ETS had lower forecast errors and better accuracy. LSTM plus random forest on technical indicator model beats the standalone LSTM. Transformer agent ensemble on stock and crypto contest had higher returns and lower drawdowns. Classifier ensembles on US stocks between 2011 and 19, 54% total profit over 8 years. Stacked deep learner plus XG boost mixed models, 3.5% improved accuracy and lower error. So bottom line is basically this inline ensemble AI strategies, yeah, harness the strengths of different models, the statistical deep learning tree based to build more robust and adaptive trading system. And backtests basically show improvements in return, reducing the forecast errors, more accuracy and risk management. They are increasingly favored by top quant firms like Two Sigma, Renaissance, and AQR. So that's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye. Hey, hi everyone. Welcome to another video. So today we are going to discuss about random walk theory and efficient market hypothesis. Okay, and how this random walk theory and efficient market hypothesis related to ETFs, which is exchange traded fund. So you must have remembered the video where we discussed about ETF, John Bogle of Vanguard and a power struggle where he took it up merger and that merger failed and the investors basically made him a fund manager. And actually, they tried to fire him, but he said he'll wage a proxy war. So they put him as a fund manager. And then he read this book called Random Walk Theory. And it was a power struggle, basically. But yeah, and, he was the CEO, who was made a fund manager. And so, was again trying to gain power. Yeah, so he read this book called Random Walk Theory and Efficient Market Hypothesis. And he believed that this is going to the future. He was again a pioneer in entire mutual funds, and he invented the low cost mutual funds. But again, he was the one who drove the ETF revolution also. And that ETF revolution, and it's a trillion-dollar industry now because of this random walk theory and efficient market hypothesis. So we'll talk about this random walk theory, efficient market hypothesis, how ETFs are related to this random walk theory and efficient market hypothesis. Can really fund managers outperform the passive index funds? And is just fund managers' performance an anomaly? Or is it really something that can be done consistently? And does past historical price data, publicly available information, and technical analysis, fundamental analysis, can be used to predict the market? Okay, all this we're going to discuss. And what are the contradictions to this efficient market hypothesis? We'll go through some examples also from US, UK, and India. So that's the topic for today. So random walk theory. So this random walk theory is proposed by Burton Malkiel in his 1973 book, A Random Walk Down Wall Street. So that's a book that's very famous. It's a mathematical, based on a mathematical concept, right? So basically says, future doesn't have any relationship with the past. Okay. So the key idea is basically is price movements are completely random. It doesn't have any relationship. At the same time, it's random also. Okay. So price movements are completely random and unpredictable. Okay. So these two things you remember. The future price movements are completely random and unpredictable. Okay. So that's the first thing. And past trends or patterns have no bearing on future prices. Okay. So that's a key assumption of this particular random walk theory. The price moves in like a random walk, like a drunkard doing a random walk, okay, down the street. Price also does a random walk on Wall Street. Okay, so that's a key idea. So that price is movements for future price movements are completely random and unpredictable, and past trends or patterns have no bearing on future prices, which is yeah. If you ask a physicist, they may not agree with this. That if time is another dimension, as per Einstein's relativity theory, you can travel past and to the future, and as per it, time is already fixed, and past price moment, everything is fixed. But that, yeah, that's all philosophical and physics. But let's come to this theory. Okay, so even technical analysis, what we do, or even in the AI algos which we are using, like LSTM, long short-term memory models, or the CNN models. Most of the models basically look at the historical price data and try to predict the future. And this theory basically contradicts that. So its primary assumption is saying that future is has got nothing to do with past. There is a saying, history repeats itself, but it contradicts that, saying that future has got nothing to do with the past, and all these past trends patterns have nothing, no bearing on the future prices, and it's all future price movements are completely random and unpredictable. Okay, even though this randomness is not there. Okay, all there is a pattern even in non randomness, and unpredictability. There is a structure. Okay, so that's what normal distribution is, right? Even if you throw balls randomly and unpredictably, they do fall into a structure. Okay, uh, but yeah, that's what this theory is. This theory basically says that future price movements are completely random and unpredictable, and past doesn't have any bearing on future. Okay, that you remember. And it also says that all available information is already priced in. So the price stock price reflects all the available information in the market or in the world. And any attempt to time the market is futile. Okay, so that's what it says. Past is independent. The future future price movement is independent of past, and it's completely random and unpredictable. And price already has all the information factored into it. So it's not possible to time the market, and that attempt to do that is futile. That's what it says. Whereas efficient market hypothesis, this is developed by Union Pharma in the 60s. What this says is all available information, past historical price data, public information, which are annual reports, all these meetings, all that, public information, and private, which is insider information, also is immediately fully reflected in the current stock prices. The stock prices basically have all this information already factored in. The past, public, and the private information is what the efficient market hypothesis says. There are different types of efficiencies. Weak efficiency says past prices and volume information is already priced into the stock price. So technical analysis is basically ineffective. That's what it says. In a weak form of efficiency, semi-strong form of efficiency, all public news, info, news, earnings, etc., are also factored into the price. And fundamental analysis is ineffective, is what this says. Strong efficient market hypothesis says all info, public, private, everything, even private means insider information, also is factored into the prices, and no one can beat the market, not even insiders can beat the market, is what this strong efficient market hypothesis says. So that's a theory, the efficient market hypothesis and random walk theory. So how these are related to ETFs? This EMH, which stands for efficient market hypothesis, and random walk theory, these support passive investing. So when you can't time the market and that effort is futile, and all technical analysis, fundamental analysis, all futile, then just go with the market. That's what it says. That's what supports passive investing, and they simply say that it's nearly impossible to consistently outperform the market. And benchmarks like Nifty 50, S&P 500, FTSE 100, you can't consistently outperform them. That's what this theory says. And ETFs have risen from this passive investing, and they are low cost index tracking vehicles, and designed to not beat the market but to mirror the market. Okay. And this philosophy of EMT and RW2 passive investing and low index cost index tracking uh, you know, has basically given rise to Vanguard, SPY, iShares, Nifty Bees, etc. ETF, entire big ETF industry got born out of it. Yeah, the question comes is now, can fund managers outperform ETFs? Yes, some can, but it's rare and inconsistent, is what this theory says. EMH says if markets are efficient, any consistent outperformance is just luck. Okay, it's not skill. But the reality is different. This theory says it's luck, but reality is fund managers like Warren Buffett, Peter Lynch, Rakesh Jhunjhunwala, a lot of hedge fund managers we went through in the hedge fund series have outperformed the market many times. Okay, they did it for decades also, suggesting that inefficiencies do exist. Okay, and yeah, but average mutual fund manager, his record is dismal, and yeah, that is true. But some people can outperform due to the skill, not just chance. That Eugene Farmer himself has confirmed that. Okay, and how EMH classifies information, historical prices is already priced in. So in the stock price, so no edge will be there via charts. The technical analysis is useless in weak form. Fundamentals like ROE, PE are already priced in quickly, so no edge in semi-strong form. Insider information is already priced in strong form. News and announcements also, market reacts instantly and no time to profit consistently. Okay, contradictions and real world violations of EMA. So that's the theory, and that's what the ETF industry came out of it, and the reality is also a little bit different for few people. There are some contradictions to this efficient market hypothesis. It's a theory and it's not bulletproof. There are behavioral biases. So people are driven by, or markets are driven by fear, greed, and herd behavior. And the examples are dot-com bubble, 2008 crash, 2020 one meme stock rally, GameStop, AMC, all these defy EMH. So okay, um, whenever there is some big event, EMH doesn't work basically. Okay, and because then fear, greed, herd behavior kicks in, behavioral biases kick in. Technical and quant analysis, yeah, many tech firms or quant firms, Renaissance, D Shaw, they do find patterns and inefficiency, and they've made a lot of money also. Renaissance makes 68%. Okay, so as per uh, EMH, it's not possible to beat the market, but they have bet the market consistently by using some quant strategies. Yeah, and if you see the record, momentum strategies, mean reversion strategies, RSI divergence strategies have shown predictive power. Okay, so predictive power is future prediction. It's not everything is prediction. We even our technical analysis, price action, everything we predict, and there's a probability to it. But yeah, these have more predictive power, contradicting EMH. So you can predict the market, and these have consistently predicted the market, contradicting efficient market hypothesis. Fundamental dislocations also, stocks like Tesla, Zomato move widely despite known information, challenging semi-strong form. So fundamentally, also, not only technical analysis, by using technical analysis, some funds have outperformed, the index, and using some strategies like momentum, mean reversion, and RSI divergence, which are all technical strategies, the funds have outperformed. Fundamentally, also some funds have outperformed because they see that the future is bright for these like Tesla and Zomato. Okay, okay. Real world examples: ARK Investment, Kathy Wood. She has bet the market in 2020 using tech future trend bets, but she underperformed in 2022. Performance is cyclical and not permanent. Berkshire Hathaway has consistently outperformed using fundamental analysis only. This shows markets are not fully efficient. In UK, also funds with equity fund bet FTSE over 10 plus years, proving inefficiencies exist in semi-strong form, which is fundamental analysis, can be used to make more profits than the index. Brexit related mispricings also, currency and bank stocks post Brexit, EMH failed to price and sentiment shocks. India also, if you see examples, so US we have Berkshire Hathaway, ARK Invest Fund. In UK, Fundsmith and Brexit. India we have mid cap and small cap rallies. Last 2 years, this is what's happening. A lot of mid cap and small cap rallies. This is driven by FII inflows, not fundamentals. But yeah, so that has also you know uh, basically failed the EMH theory. Adani Group stock surges and crashes also. Price moved much faster than the public information flow, news flow, violating EMH. Retail traders using RSI super trend on zero the kite still find repeated success, not explained by EMH. Okay, so people using RSI are able to find success, which EMH can't explain. EMH means basically all this technical fundamental analysis is all useless. Even insider information is useless in some markets, and just follow the index. Don't do any fund management. Is what it says, and these are all the anomalies to it. Uh, like Berkshire Hathaway has used fundamental analysis to beat the market. ARK Invest uses sectorial bet to future bets to beat the market, and Fundsmith has consistently performed 10 plus years. Mid cap, small cap rallies have nullified this EMH theory. RSI super trend, technical analysis also. All quant firms use technical analysis only, and mathematics, and they have bet the market consistently. Okay. So reality check, random walk theory, partially true. It's only true in ultra liquid and low volatility periods. Okay. Efficient market hypothesis holds for large caps only, but often fails in small and mid caps and even crisis situations also. And fund managers outperforming, possible. Only few people do, but not everyone. It's rare and often inconsistent. ETFs are ideal for average investors, low cost and market matching returns if you want. Okay, this entire ETF came from this random walk and EMT theory, and by one person called John Bogle of Vanguard. Okay, and technical and fundamental analysis, it's still efficient in some pockets of the market, and you can make good generate good returns. So that's the random walk theory and efficient markets for you guys for today. And that's it for today. Thanks everyone for having a nice and have a nice day. Bye. Hey, hi everyone. Welcome to another video. So today we are going to discuss about Lorentzian classification ML model and how it could be used in forecasting, in trading, and at both intraday, positional, and swing trading. How we can use it, and whether hedge funds use this Lorentzian classification AML model, how it came into being, who invented it, and how successful is this Lorentzian classification AML model, and what are the returns that this model AML model generated with some specific examples. So that's the topic for today. So Lorentzian classification, it's a machine learning classifier basically. So it's a machine learning model, and it's a classifier. Okay, that uses Lorentzian hyperbolic distance. So this Lorentzian hyperbolic distance is more of a physics concept. It is used in relativity. It's a physics concept, but it is applied to financial markets also, and yeah, so that's what this is. So this machine learning classifier uses Lorentzian hyperbolic distance, which is a mathematical measure sensitive to hierarchies and sudden market events. Okay, for nearest neighbor classification in time series data. So based on this Lorentz model from theoretical physics, relativity, this is basically derived, and it came from, and it captures price time warping. Okay, example, how markets react to events like FOMC meetings. So that is what it is very good at capturing, how markets react to events like some FOMC meetings. And this model came from theoretical physics, especially from relativity concept, and yeah, it is used finding the nearest neighbor classification in time series data. History and inventories, it's developed by Justin DeHorty, who released this as an open source trading view indicator in early 2023. We will go through this trading view indicator and what its features are as a part of this video. Okay, and what it does, how it generates signals and all that. It quickly rose to popularity. It became top 10 editors picks, and 20K plus bookmarks were done on TradingView due to its unique ML integration. How it works, it embeds price, value, volume, and momentum. So these three things it embeds into Lorentzian space: price, volume, and momentum. These three things are embedded into Lorentzian space. Only thing that's missing is volatility here, but volatility you could use Bollinger Bands to find the 1 SD, 2 SD, 3 SD levels. uh, you can use it with along with this, but this already has the price, volume, and momentum features into this Lorentzian space. And this uses Lorentzian distance for nearest neighbor classification, and this model is more resilient to anomalies and outliers like news spikes. Suddenly some news came, it is more resilient to that news spikes and anomalies. It gives you a buy and a sell signal, a classification signal, and often this buy and sell signal is like an arrow or a marker in TradingView, and it integrates well with filters like 200 EMA, which is a trend yeah, super trend, which is again a trend indicator, ATR stop loss, which is stop loss related indicator. Okay, so how this Laurentian space performances and examples of the Laurentian space AML model in financial markets is backtest from Trade Searcher have shown compelling results. So WBA and company, which is Walgreens Boots Alliance, on 1 hour time frame when 75 trades were taken using this Laurentian classification ML model. 8.46% risk reward ratio was there. A total return on investment of 108% was achieved. So 108 is very big achievement, almost double capital, right? And Unity, a company on 4 hour time frame, 75 trades when they were taken, risk to reward is 1.33, return on investment is 18.2%. Snap on a daily chart, 51 trades were taken, risk to reward was 1.74, return on investment is 42.05%. So TradingView scripts incorporating 200 EMA super trend have shown consistent results on US 500 in 1 hour chart, and Bank Nifty 4 hour and 15 minutes chart. When you incorporate this Lorentzian indicator with 200 EMA or super trend. Very good results are seen in Bank Nifty on a 4-hour chart and a 15-minute chart. One of the Reddit feedback confirmation confirms its adoption. So Laurentian classification can be used to predict the direction of future price movements. So this does forecast the future price movements also. Okay, so that is the beauty of it. So it predicts the direction of the future price movements. It also tells you the prediction accuracy of the future price movement. So application across time frames you could do intraday from 5 minutes to 1 hour you could do. It captures short term trend shifts. You can add some EMA or ATR filters. Swing also you could apply 4 hour to 1 day time frame effective for multi-day moves you could capture, especially when combined with trend filters. Positionally, daily, weekly time frames also you can use. Long-term entries are confirmed by clear classification after major events. So trend searcher suggests that refine with chart patterns, volume analysis, and trend filters. Use trailing stop and multi-target exits. So when you use this Laurentian classification with chart patterns, which is price action, volume analysis, and trend filters, uh, then and use trailing stop or ATR stops, then it gives better results. So hedge fund and quant use cases, hedge funds can integrate this nearest neighbor Laurentian core into broader ensemble models. Ensemble is an AI model which has a combination of all the models. Example, combine it with LSTM, long short-term memory model, transformer model. You could combine this Laurentian nearest neighbor model also for robust forecasting. It's valuable during event-driven scenarios, especially when market behavior warps differentially than typical days. So that time, this is very useful. This model is very useful and it performs well. And it could be included in multi-layer forecasting pipelines, aiding in signal generation for intraday behavioral and trading. Okay, it's a forecasting tool, and you could combine it with so other AI models like LSTM and transformers to get a robust forecasting, and it's very works beautifully during event-driven scenarios, and its backtest results are also very positive. Okay, so around 108% returns are there, 42% returns are there on certain companies like Snap and WBA. Even on Bank Nifty, there is a consistent returns. Only thing is some filters you need to use, like chart patterns, volumes, and trend filters have to be used. So summarizing this, inventor is Justin Doherty. It's an ML classifier using Laurentian distance and nearest neighbors. It captures time warp relationships in price action. Backtest results show 18 to 108% in various time frames on companies like WA, Snap, and Unity. Strategy is you can use Laurentian this ML indicator with 200 EMA, super trend, and ATR stop loss. Time frames you can use it on intraday swing positional. Hedge fund event driven strategies this could be used. Ensemble signal input it could be used. Anomaly resilient classification it could be used for. It could be used on multiple platforms like US stocks, indices, crypto, and bank nifty. The final takeaway is this is a model. This Laurentian classification model is a pioneering blend of ML and advanced geometry, and it delivers robust classification based trade signals across multiple time frames. And its strength lies in anomaly handling and event sensitivity, and it's a strong candidate for hedge funds seeking AI driven edge for event driven strategies. Backtests show solid results. Okay. But again, risk control should be there and thoughtful integration should be there. So let's see how this AML classifier is there. Okay, so this is the Laurentian classification uh, indicator. Okay, so if you indicate it, this is how the numbers come. Let me open this indicator so that we'll go through what it means. Yeah. So this is a machine learning Laurentian classification. So what it's doing is it's pointing some numbers. Okay. So it's giving you a signal. So this is a sell signal. This is a buy signal, and then numbers are being pointed. Okay. So red numbers means it's sell, and green numbers means it's a buy. Okay. So that's what this is, and let's go deeper into this. So yeah, JD Herty is one who made this indicator. It is the top picks, editor picks, and it has 24.8K subscriptions to it. So what does this tell? This particular thing tells us it's a classifier. This Lorentzian distance classifier is a machine learning classification algorithm capable of categorizing historical data from multidimensional feature space. Okay, this indicator demonstrates how Lorentzian classification can be used to predict the future price movements. Okay, predict the future price movements when used as a distant metric for novel implementation of approximate nearest neighbors algorithm. So background, he tells, basic Lorentzian space is best known for Einstein's theory of relativity, and it's used in theoretical physics, but it's also applicable for trading. And yeah, what he says here is this Lorentzian space is good suited for time series data, and the hypothesis and empirical studies show that Lorentzian distance is more robust to outliers and noise than other indicators like Euclidean distance. And Laurentian distance outperforms other highly regarded metrics like Manhattan distance, Bhattacharya similarity, and cosine similarity. Okay. And he also says that that when dealing with financial market data, such as FOMC meetings or black swan events, this is very good. This particular indicator is very good, and this event-based distortion market data uh, is basically similar to gravitational warping. Okay. So it is good for for financial markets, especially during certain events. Okay. And this is how he classifies it: CCI, ADX, and RSI, and nearest neighbors and farthest neighbors. Okay. How to use this indicator? So basically, if you see this, so these are all the categories or model assigns to each candle. Basically, more positive numbers indicate that bullish sentiment is there, whereas more negative numbers indicate bearish sentiment is there. Okay, sequential patterns of these numbers can be caused to help identify fractals and inflection points. So basically, more negative numbers are there, it's a bearish thing, and more positive numbers are there, it's a bullish thing. Then there is intensity of the signal also. So this is confidence level by this model, which basically tells entry point, okay, of where we need to enter. And this line is an estimate based on kernel regression using a rational quadratic kernel. So this is basically this line is predicts basically that this is how it's going to be, and the real thing is most likely like this. And it also gives you statistics. When this model is applied on the 2000 bars, on back tested, how win rate is how much on how many trades, and what is the win ratio and stop loss hits. Also, it gives you this particular indicator. Okay, so that's what this is, and it uses a lot of features like RSI, CCI, ADX. All these are used. So this is the Laurentian classification, guys. So if I apply it today, if you see, more negative numbers are there, which basically means that till here the market is bearish, and from here again positive numbers are there, which indicates bullishness and bearishness. Yeah. So that's it for today, guys. So this is a Laurentian classification AML model, which can be used to predict the prices, and it's a AML model, which has which is very good when event driven things are there, and uh, for anomalies, it responds properly, and back test results have been very positive, generating 108 to 42% returns. Yeah, so that's it for today. You need to use some filters also, like you could use a Bollinger Band for volatility, and EMA super trend for trend, and stop loss for further refining this model. Thanks everyone for joining the call. Have a nice day. Bye. Hey, hi everyone. Welcome to another video in our AI predictive models series. So today we are going to discuss about how mean reversion and statistical arbitrage AI models are being used for trading and for predictive modeling in trading, and what are the important examples, specific examples we'll go through where mean reversion with statistical arbitrage AI models are used in trading. Okay. So, what is mean reversion and statistical arbitrage? So, mean reversion is basically, these strategies. What they do is they assume asset prices deviate temporarily from the historical average, and only to revert back to the historical average. Okay, so historical average is the reference point, and asset prices will only temporarily deviate from this historical average, and eventually they will revert. So, that is what is mean reversion. And statistical arbitrage is applying this mean reverting logic over a pair of pairs. Okay, pairs is basically two stocks. Okay, two stocks or baskets. You can apply it over baskets also of correlated assets. So correlation is if one asset moves, if the correlation coefficient is near to one. If one asset moves up, the other asset also will move up. Like silver and gold has a correlation of one. So similar correlated assets. So we can apply this mean reverting logic over a pair or a basket of correlated assets. And what the strategy will do is it will go long on undervalued assets. Undervalued is something which is below the mean, and overvalued assets, or short the overvalued ones, which is above the mean, basically. So that's the basic strategy, and it makes profits eventually when they both revert to the mean. So how we can apply this AI models, for mean reversion is first we need to do a pair selection. So algorithms can scan for co-integrated assets uh, or stocks, basically, whose spread is statistically mean reverting. And how do you know, this stocks or co-integrated stocks whose spread is mean reverting? Is they use something called as an ADF test. So let's go into that. So co-integration in the context of finance refers to a statistical relationship between two or more series variables. Okay, which where they tend to move together in the long run. So even if they deviate in the short term. So basically, if gold and silver, this is the mean, and if it goes up, gold is when to go up and silver is going down. Eventually, they will come to this mean and go here. Okay, so that is what this co-integration is, where they tend to move together in the long run, but in the short term they can deviate from the mean. And this ADF test, which is an augmented Dickey Fuller test, is a statistical test which is used to determine if a time series is stationary or contains a unit root. Okay, so in the context of co-integration, basically, if we did the ADF test, what we would do is we will just try to find whether it's stationary or there is a unit root. And if we get in the ADF test stationary, that would indicate co-integration. Co-integration basically means two variables or two assets will tend to move together in the long run, even though they are deviating in the short term. Okay, so what we will do is pair selection. So algorithms can scan for these co-integrated assets, which will eventually go in together, uh, and they will find out those assets, co-integrated assets or stocks, which are whose spread is statistically mean reverting through ADF tests. So in ADF tests, it is stationary. Stationary is coming means those two stocks are co-integrated assets. Then we'll use signal generation. We'll do after pair selection. What we will do is use machine learning to trigger trades based on when the spread moves x deviations from the mean. Okay, as I told you, if it goes above the mean, we will short it based on the standard deviation. If it's one or two standard deviation, we will short it because eventually it should come to the mean. And if it goes below the mean, one or two standard deviations, we will go long on it. So that's what these trades will do. So they'll trigger trades when spread moves x deviations from mean, and they will reverse positions when spread toward reverts to the average. So like this is the average. Gold has gone two standard deviations up, and silver has gone two standard deviations down. Then we'll short this position, and we will along this position, and we will exit when both have reverted to the mean. So that's what these algos can do, and machine learning can do. They could trigger trades. They could first identify which pairs are co-integrated assets through ADF test. Then they could trigger trades based on the deviation from the mean. AI enhancements, auto encoders plus reinforcement learning. This models, what they could do is they could learn optimal pairs and positions. So what is the optimal pair which is performing well, what are the positions, position size, and when we need to exit the timing. This it can do adaptively. Neural nets can detect latent spread drivers or nonlinear dependencies. So few of the examples we'll go through, backtest and performance highlights of this mean reversion and the statistical arbitrage models. In the Indian market, sector pair trading. So a project was on NSE stocks across sectors using spread, Z score, and Bollinger Bands with ADF selection was done, and this strategy generated market neutral returns. Bollinger method proved more robust. So Bollinger basically is one standard deviation or two standard deviations from the mean. So I mean, a test was done across sectors using this ADF selection. Then yeah, it generated market neutral returns. In US, Nui Quant, so James Algo, positional mean reversion strategy on stock futures from 2003 to 2020, which achieved 80% net gain in 2020 post cost. There it achieved 80% with modest drawdowns. Okay, on stock futures in from 2003 to 2020. Actually, mean reversion is one of the main strategies of even Renaissance technologies initially when it was founded. After machine learning algorithms came into picture. Yeah. NSC Nifty 5 minutes in India. So mean reversion strategy using Bollinger Bands again. Okay. So when the stock reaches up to two standard deviations or the upper limit of the Bollinger Band, you short it. At the same time, when it reaches a lower Bollinger Band, you'll take a long position. It returned 89% net return, 62% annualized return with 10% max drawdown. US S&P 500 gaps statistical arbitrage. So mean reverting overnight price gap strategy. 1998 to 2015, some variants delivered 62% annual return post cost, which well above 1.8 buy and hold. US robust lesson, a portfolio of co-integrated S&P 500 pairs returned 35% in 2020 with 85% trade win rate and beating S&P SPY 20% return. So AI-driven enhancements are, we can see it auto-encoder reinforcement learning models provide end-to-end optimization, outperforming the classical two-stage strategies. Deep reinforcement learning statistical arbitrage on S&P 500 learns adaptive entry, exit, and spread construction. High-dimensional neural net statistical arbitrage across 50 assets shows robustness even in crisis periods. So performance at a glance. So NSC Nifty 5 minute mean reversion generated 89% net returns and 61.9% per annum, and drawdown just of 10%. Robust short-term gain 62% annually. S&P overnight gap mean reversion 62% annual post cost and 1.8 B&H. High efficacy persisting over 17 years. S&P 500 pair portfolio 2020 35% sharp, greater than the SPY. SPY is an ETF. Okay, so it performed better than that. 85% winning trades outperformed during the crash recovery also. Okay, positional stock future algo James one. 80% gain in 2020 net of cost, okay, after cost basically, and strong single year performance post slippage. AI autoencoder plus reinforcement learning statistical arbitrage models outperforms the classical models. Simplified pipeline with high gross returns. AI reinforcement statistical arbitrage models, adaptive strategies outperform static ones. Fully data-driven optimization across marketing regimes. AI high dimensional neutral statistical arbitrage models, robust returns across 50 assets, works even when co-integration weakens. So why do they work? They have a statistical edge, basically. Okay, as per statistics, normal distribution. Yeah, mean reversion is a phenomena that happens very often, and yeah, generally things that go away from the mean will converge to the mean, and that's a standard. Especially it applies to price a lot. Okay, so that statistical edge is there, and these models capitalize on that pricing inefficiency with discipline and data-driven approaches. AI enhancements, what they do is they help us to identify the spread detection, position sizing, and exit timing. Risk control, market neutral stance helps preserve capital in volatile phases. Portfolio scaling, this works across baskets and sectors, and greater diversification is there. Okay, caveats and considerations, overfitting risk is there. AI enhanced models can overfit. Rigorous out of sample testing is essential. Okay, and execution costs, high frequency trading includes slippage and brokerage. Strategies tested account for this. Okay, yeah, so basically after costs only, the strategies are giving better results. So the slippage and brokerage costs are included in it. So, but yeah, we need to consider when you do high frequency trading, there is a lot of slippage and brokerage, and the strategies need to be profitable after the slippage and brokerage. So that needs to be tested also, and we need to use some out of sample testing also to avoid overfitting risk. Minor regime breakdown, so pair selections may diverge. Real time monitoring is critical. So you can't just leave it to algos, some real time monitoring is needed. Bottom line is mean reversion and statistical arbitrage strategies enhanced by AI have consistently delivered strong risk adjusted returns across markets, India, US, and time frames also. And incorporating this deep learning and reinforcement learning optimizes entry exit asset choice and leverage. And with disciplined back testing and cost aware execution, these strategies remain powerful tools for prop as well as quant trading operations. So that's the mean reversion and statistical arbitrage AI trading models for you guys today. And yeah, that's it for today, guys. Thanks everyone. Have a nice day. Bye. Hey, hi everyone. Welcome to another video in our hedge fund strategy series. So, today we are going to discuss about the quant model strategy. So, we already discussed about global macro hedge fund strategy, and then we also discussed about yesterday the contra trading strategy. Today, what we will discuss is the quantitative hedge funds, which basically refer to hedge funds which deploy advanced mathematical models. And these mathematical models generally comprise of statistical models and computational models, and use a lot of statistics probability to come up with mathematical models that can give signals which can be traded upon to make profits. The quant hedge funds also use massive data processing. They collect data from a lot of places, and they try to find patterns and anomalies which are repeatedly occurring within that data, and then backtest those particular anomalies or patterns and see if they're profitable, and based on that they deploy those models to make profit. So the main two quantitative hedge funds which are very famous in the world are Renaissance Technologies and DE Shaw. So Renaissance Technologies is the flagship fund is called Medallion Fund, and DE Shaw is DE Shaw Composite or Oculus. It is. So Renaissance Technologies is very popular. It's able to generate 66% annualized returns every year. That's the highest that any fund has been able to generate till now, and it's all mathematical and statistical. So if you see the edge of this fund, the edge is proprietary signals which come from obscure data using machine learning, statistics, and physics. Okay, so that is the edge of this particular fund, and they employ the employees who work in Renaissance Technologies are mainly PhDs in physics, maths, and computer science, and very few with finance background. Okay, whereas D Shaw is able to generate 10 to 20% annualized returns, and it uses multi-model statistical arbitrage and predictive analytics. Okay, it employs quant scientists, computer scientists, and linguists, and as well as traders. So coming to Renaissance technologies and even DE Shaw, they highly rely on the first model, which is a core quant model. It is called statistical arbitrage. So what this particular model does is it identifies pricing inefficiencies in correlated assets, and they trade. The strategy that is used is mean reversion or conversion. Okay, so the price, if it is going away from the mean, uh, then it has a tendency to reverse to the mean. So that is the what is called as the mean reversion strategy. So if the price has gone too far from the mean, either in the positive direction upwards or downwards, it will definitely come back to the mean. So that is what is a mean reversion. So, and this particular technique or the statistical model is used by the quant hedge funds to identify the pricing inefficiencies in correlated assets, and yeah, this works a lot in commodities market, and yeah, so this is the main strategy, and it is done in a high frequency trading manner. From milliseconds to multi-day patterns are identified and traded upon, and both funds heavily rely on this particular model. Okay, techniques used for this are pairs trading. Okay, pairs trading, you could use basket arbitrage, you can use high frequency implementation of micro arbitrage strategies can be used. Okay, so this is the first one. So yeah, coming to Renaissance Technologies, it initially started with mean reversion strategy, and it made a good amount of money. But when its mean reversion strategies started failing, then what it has done is it has uh, and there was a limit on how much can be traded upon in the commodities market. uh, yeah, commodities market. So yeah, when the Renaissance technologies found mean reversion strategies were failing or not generating so much returns as they used to. Then they have pioneered this entire machine learning models. Okay, so machine learning models deployment in the financial markets was first or done by Renaissance technologies. So who is this guy who invented this Renaissance fund? So let's talk about that first, so that we know what we are talking about. So James Simons is the person. So he is uh, was a professor at MIT, and he was a former NSA code breaker, and he was an excellent mathematician. And his emphasis was on pattern discovery. Okay, and David Eshaw is a PhD in computer science, and he was an early AI and NLP researcher. So this guy is from Columbia. He used to teach at Columbia. He used to teach at MIT. Okay, and the main fields that they use to develop these models are statistical physics, information theory, Bayesian inference, and complexity science. Okay, that's their academic background and roots. So coming to our techniques, so we discussed about mean reversion or statistical arbitrage, and identifying pricing inefficiencies in correlated assets that being used by both the funds heavily to make money. Then yeah, once the profits decreased in the mean reversion, then machine learning models were deployed first by Renaissance technologies, and this machine learning models, what they do is they predict the price movements, and they forecast the order flow imbalances, and they model market microstructure and adaptive position sizing. These four use cases they cater to. Predicting price movements is the main one. Forecasting and using all these four use cases, signals can be generated, and trades can be executed to make money. This is what is the edge that the company has. These are the different algorithms or mathematical models: random forests, neural networks, reinforcement learning, which are used to basically trade. And these are basically prediction systems or forecasting systems, and these mathematical models are behind them. And these mathematical models and prediction give an edge to this prediction and forecasting systems. Okay, so that's the second one. Basically, machine learning models deployment to have an edge and to trade and generate trading signals to trade. The third one is signal mining. So this is massive data is basically stored, and the data sources that are stored are pricing data, like historical pricing data, volume data, fundamentals related data is stored. Apart from that, even satellite imagery data, weather data, shipping logs data, Twitter sentiment, even data basically from websites, patent filings, academic papers, even restaurant reservations, and social media news. All this data is basically collected, and then the techniques of national natural language processing, um, the time series anomaly detection, semantic similarity, and topic modeling in auto ML pipelines are used to generate signals, basically. So trading signals by mining these massive data. And Renaissance Technologies is a pioneer in this one also. It is rumored to have maintained terabytes of cleaned data going back decades, stored in proprietary formats. Okay, so this is the third technique, where it's basically signal mining massive data. We already discussed about statistical arbitrage as well as the machine learning models. The fourth one is market microstructure model. So this tries to you enter quickly and you exit quickly. So ultra short term trading it is called, and this ultra short term trading and the prediction of order book dynamics. So this is what is used to make money. Medallion fund uses this. It is termed by a name called basically it relies on probability theory, and it is a systemic probability trading mechanism. Okay, and the different techniques are used here: optimal execution algorithms, latency arbitrage, limit order booking modeling. These are used to um, do this ultra short term trading, and the trade is done on a particular trade which has a probability uh, of success more, as well as risk to reward properly aligned to it. Okay, then yeah, DE Shaw does something different. DE Shaw uses macro modeling also. It's not purely mathematics that is done. DE Shaw uses combination. It uses multi-factor models, so it uses things like value, which is basically price, and the momentum. What is the momentum? Quality, the sentiment, news factors. News also it uses short-term technical momentum and reversal factors, and regime switching and adaptive beta filters. Okay, so it basically blends fundamental signals also with the mathematical models, and it's like a hybrid quant model compared to Renaissance. Renaissance purely relies on mathematical models, and has its edge in those mathematical models. Yeah. So what makes these particular models work is signal density. So thousands of microsignals are generated, which give them the edge to make profit. In case of Renaissance, in case of DE Shaw, very few signals are generated, but these are very strong signals because they use both finance and math. Data quality, so they have a lot of obsessively clean, normalized, denoised data, and DShaw uses structured and unstructured data to identify patterns and signals. So DShaw has something called as a ghost patterns identification. It identifies its models identify uh, the statistical anomalies which occur frequently. Okay, and those statistical anomalies, when they occur frequently, you can make money of those particular statistical anomalies. Okay, yeah, that is one thing. And yeah, even Renaissance technologies uses not only mean reversion, it also uses linear regression techniques. um, okay, and yeah, AI also, and ML also it uses apart from high frequency trading. So they have the best in class execution algorithms, and it is strong in execution and macro modeling. Yeah, so these models relearn from outcomes. These feedback loops are there, and this is human plus AI oversight. DE show has culture of Renaissance is pure quants, few finance people. This is a mix of academia, finance, and engineering. DE show. Okay, so this is an example. ChatGPT has generated for a Renaissance micro signal. So if you see this, um, price spread between SPY and IVV. So it is when signal is greater than 2, it is shorting SPY and long on IVV. If it is less than minus 2, it is long on SPY and short on IVV. And these companies like Renaissance may use such 1 lakh plus micro signals and blend them to get ensemble weighting. D show uses this multi-factor model. So zero point 0.4 into value, zero point 0.3 into quality, zero point 0.2 into news, zero point 0.1 into means reversion. So this is their model. This is the alpha score, and if alpha score is greater than threshold, enter this position. Okay. So these are the models, guys, and the ghost patterns. So ghost patterns, I told you, is used by DE Shaw, which identifies statistical anomalies. Okay. Other than this, there was a fund called LTCM, a long-term capital management, which made a lot of money, around 40% when it was successful. But it failed because of Russian bond default. Russian government has defaulted on its bond payments, and that's what has made that fund go bankrupt. And it assumes a normal distribution, and it assumed a normal distribution, and one black swan event, like the Russian government defaulting on its payments, has totally wiped off that particular fund. DE Shaw, to counter that, uses it doesn't assume the normal distribution. It even counters for the outlier uh, black swan events, and models them also, so that that is also taken into factor to from a risk management perspective. So that's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye. So this video will go through the comparison of different algo platforms and that are used in India by hedge funds. We will also go through, what is the fixed API integration, and overview of back office softwares like ease and numerics for Indian fund use. So that's the topic for today. So trading platforms comparison template, and this is all India focused. Okay, so in India, the platforms that are used are Odin, which is developed by 63 Moons, and it is used on asset classes equities, derivatives, and commodities, and it has fixed API support. Features that it provides are broker hosted algo execution, and RMS, and integration, and OMS. RMS is risk management system, and OMS is order management system. These features it provides. And advantages: it's widely used by large brokers. It is SEBI compliant and full service brokers and funds. It is suitable for. Okay, this Odin. Next one is Presto ATS. This is developed by Symphony FinTech. Asset classes that it supports are multi-asset, NSE, BSE, and MCX commodities also. Fixed API support is there in this, and features are multi-legged algo support is there, market making is there, and latency management is also there. Okay, so advantages are advanced GUI is there, and scripting interface is there. It is suitable for quant firms and market makers. Okay, so if you want to do market making, this is good. Most of the firms, hedge funds, do market making nowadays. Even Jane Street does market making in a lot of ETFs. Okay, so this software does support market making thing along with latency management. Yeah, then we have Ominous Nest. This is developed by Thomson Reuters, now Ion Group, and yeah, it supports equities, F&O, and currency. And, you know, fixed connectivity is there via RMS module. Basically, fixed API support is there via RMS module, and yeah, the features are DMA access, and broker hosted algos are there, and customizable UI is there. Advantages is integrated risk management system is there, risk control is there, fast API is there. It's suitable for funds using broker APIs. If you're a fund you want to use broker APIs, then Ominous Nest is good with good risk management integration is there in this. And Odin is also good. This is also broker hosted algo execution. Okay, but this market making is there in Presto ATS. Then we have RTD Tango. This is reliable software has developed it. It is it supports equity, F&O, and currency. Fixed API support is there. Its features are GUI for strategy building is there. Live testing and deployment features are there. It's lightweight and affordable, and this is beneficial for mid-sized fund and high frequency trading enthusiasts. So for high frequency trading, you can use this. Algo Studio. So this is developed by Algo G, and it's an open source one. It supports NSC equities and derivatives, and FIX API connectivity is there through broker. A lot of ML support strategies are there. Backtest engine is there, and broker bridge is there. Custom ML plugins, open design are the benefits, and this is useful for Python based quants. Then we have Spider Iris Plus Algo, which is developed by Spider Software. It supports equities in NSE and BSE. Fix API connectivity is not there; it's proprietary. Uh, Benefits are chart based trading is there, and custom scripts you could use. It's good for discretionary algo and hybrid trading. Retail algos and SEM pro firms can use this software. Okay. So that's a comparison of different algo softwares that are there, and what who developed them, what are the asset classes that they support, and whether fixed API support is there, what are the features, advantages, and who it is suitable for. Okay. And coming to fixed API integration, this what is fixed API? Fixed API is Financial Information Exchange. That's what FIX stands for. It's a standard protocol used to communicate orders, trades, and market data between trading platforms and broker exchange systems. Okay. So it's basically an API which allows for communication of orders, trades, and market data between trading platforms and broker and exchange systems. And FIX stands for Financial Information Exchange. It's a standardized protocol. Why Indian funds use FIX API? Because it enables custom algo trading platforms to integrate directly with brokers and exchanges, and it reduces latency versus GUI platforms, and it offers granular control over order types, timing, and execution logic. Common brokers who are offering fix in India are Interactive Brokers India. Okay, so offers this fix API connectivity. Zerodha also offers via Kite Connect. Upstocks offers for institutional clients. Novama, formerly Edelweiss, also offers this fixed API connectivity. Symphony FinTech via Presto Fix Hub, they also offer this fixed connectivity. What is this fix used for? It's used for high frequency trading, statistical arbitrage, smart order routing, multi-legged option strategies. These are the use cases where this fixed API connectivity is used for. Back office and order management and portfolio management softwares for Indian hedge funds are, this ease investment suite. This is developed by SS&C. Key features are portfolio modeling is there, order management is there, compliance is there, compliance workflows are there. This is for order management, position tracking, and compliance reports. Common users are mid to large hedge funds. So this does all the portfolio modeling, order management, and compliance workflows. Okay. Numerics is there, which is the key features are derivatives pricing, risk management, and XVA, used for valuation, value at risk, and risk simulations. And this is common users of this are derivative focused funds and quants. Hedge tech is there, which allows you to do NAV calculation, investor reports, and fund accounting. And NAV calculation is an important part of hedge fund, okay, and even a mutual fund also. So they have to do it at the end of every day if they're doing market to market reporting. Okay. So this does NAV calculation, investor reports, and fund accounting. It's used for fund administration and LP reporting. Common users are boutique funds and alternative investment funds, which are yeah. Alternative investment funds include hedge funds, private equity firms, venture funds. Okay. Miles software. This is Credence PMS, multi-asset portfolio management software. Compliance and client reporting are the key feature, along with multi-asset portfolio management, used for family office portfolio management and compliance. Common users are domestic portfolio management software platforms. Then we have FundWave. This is a cloud-based private equity venture capital fund administration and investor reporting is the key features of this particular software. And this is used for alternative funds and audit integration, mainly used by VC funds and new age alternative investment funds. Quant Institute's Blue Shift. This is used for back testing and strategy execution in Python, and that it supports. Those are the key features: back testing and strategy execution in Python. And basically, algo back testing and deployment you could do using this quant entities blue shift, and it's used by quants and Python developers. So these are all the backend softwares which help you in compliance reporting and risk management, portfolio management, backtesting, strategy execution, nav calculation. All this this will help you. So basically, the summary is Odin and Nest are dominant in broker-driven institutions. As far as I remember, I think Nest is also used by Zerodha, but this Odin and Nest are dominant in the broker-driven institutions. Presto ATS is preferred for latency-sensitive, co-located setups and customized high-frequency strategies. If you want to deploy, Presto ATS is good. RTD Tango and Algo Studio provide developer-friendly interfaces for quants who want to build and deploy ML-based strategies. Fix API gives edge to hedge funds in India for automation, latency reduction, and customer strategy execution. And this is numerics hedge tech. They support fund operations from front office to back office. This is crucial for compliance, investor servicing, and regulatory audit support. Okay, so that's the comparison, guys, of different back office softwares, as well as the fix, what fix stands for, and who provides that, along with the platforms, algo platforms comparison, okay, with their features, advantages, and who it is suitable for. So that's the topic for today. That's it for today. Thanks everyone. Have a nice day. Bye. Hey, hi everyone. Welcome to another video. So today we are going to discuss about AI agents and how these AI agents can be used for algo trading in India, US, and UK. And we'll go through some of the AI agents that are already being used and some of them which are popular ones. And we will go through specific examples from India, UK, US, and of the AI agents that are being used for trading and algo trading. Okay. So, what are AI agents in trading? So, AI agents are software tools that are autonomously, they basically these artificial intelligence agents or software tools, which without any human intervention, autonomously they can analyze the market data, they can generate the signals on their own, and they can construct strategies on their own, and even in some cases they execute trades with minimal human supervision. Okay, so it is all automatic basically. These AI agents are autonomous. What we can call is AI bots working for us, which can automatically analyze the market data, generate signals, and construct strategies, and in some cases execute trades with minimal human supervision. Okay, and these AI agents use natural language input, ML models, machine learning models, and algorithmic frameworks. Okay. Yeah, but this executing trade with minimal human supervision and analyzing the data, generating signals, and constructing strategies is autonomously is the main task of these AI agents. And in the background, they use language learning models or natural language models, machine learning models, and algorithmic frameworks. So let's see some of the AI agents which are in already existence in India and platforms. Okay, so U-Trade Intelligence, which is called U-Trade Algos, is there in India, which is an AI-driven suite. It is which combines an AI assistant. Okay, so this AI assistant, what it does, it recommends strategy based on your capital, risk tolerance, and goals. So it describes this, it recommends a strategy for you. And AI, there is something called as AI strategy builder also, which enables no-code, plain language strategy creation in Hindi or English, and with backtesting and deployment. So it has this AI-driven suite has AI assistant, which can recommend a strategy for you, and AI strategy builder, which can once you give a plain language strategy, it can create that strategy and can backtest and deploy it. This is built for retail and RI traders and to leverage algo trading with institutional grade machine learning insights without coding. Okay. Then we have AlgoBulls, Traditron, Lars, Algotech, Sensible also. These platforms in India are also offering AI based strategy generation, optimization, and execution. So they have some drag and drop or template based designs and backtesting features and automation features. For example, AlgoBulls has 500 plus AI driven strategies and indicator based trade signals are also there. Okay, and Lars offers real time risk evaluation with portfolio optimization. So coming to US, some of the existing AI agents are trade ideas. They have something called AI agent Holly, and it's a reading platform utilizing an AI agent named Holly. And what this Holly does, it scans global markets continuously and proposes some trade ideas based on evolving patterns and adapts over time. So it's scanning the market and giving some recommendation of trade ideas based on certain patterns, and it's adapting over time also. Then we have Cabot K-score agent in US. It uses machine learning models and multi-source data to score equities on future performance potential. The K-score functions like an AI agent for stock selection and signal generation. So these AI agents are basically doing stock selection for us and proposing trade ideas for us by scanning global markets and using ML models and multi-source models to score the equities for future performance. Then we have Quant Connector Alpha Streams. This is not really an agent in NLP terms, but it enables quants to build, test, and monetize AI and ML-based automation strategies on a cloud-based platform. And many of their strategies are licensed to institutional users. Then we have Volion Group, G Research, and Two Sigma. These are institutional funds relying on AI agents and machine learning systems that autonomously generate and adjust trade signals on a day to day across equities and derivatives. Coming to UK and regulatory landscape, large firms like G Research and GSA Capital employ AI agents for predictive modeling and execution. And regulators like SEBI in India and UK FC are issuing guidelines to monitor deployment of autonomous AI and ML trading systems amid concerns that about market volatility and manipulation risk. So summary is, in India, you have AI agents or platforms like UTrade, Intelligence, Algo Bulls, Tradetron, Sensible, and Labs. Use cases are no code strategy building and retail algo automation. Popular examples are UTrade AI Assistant and Strategy Builder and Algo Bulls AI templates. USA and globally, we have Trade Ideas has Holly AI agent. Uh, Kavot has K-Score, and Quant Connect and Volian and Two Sigma and G Research also have a agents. What these do is they feature, scan the entire global markets for tradable ideas, and they generate the AI signals and ML based systemic trading they do. Examples are Holly by Trade Ideas, K-Score AI from Kavot, Quant Connect Baptist deploy pipelines. UK and EU, you have institutional agents at G Research, GSA Capital, and Citigroup pilots. They are used for risk forecasting and execution planning. Popular example are Falcon Slot with and IA for FX and AI compliance toolkits. So, what are the advantages of AI agents in trading? So, rapid strategy selection and deployment via natural language. Okay, so you just tell it the plain, strategy, and it will scan the markets and provide you trade ideas, and at the same time enable you to trade with the strategy. Continuous learning and adaptation is there as market shifts for these AI agents. They continuously learn and adapt to the market shifts, and they rapidly scan the entire data and give you some recommendations. They understand the natural language only, and yeah, so the key advantages of AI agents in trading are rapid strategy selection. They help us to scan the global markets and come up with trade ideas, and they understand the natural language and help us to deploy the strategies. Examples are U-Trade and trade ideas, and continuous learning and adaptation is also there for these AI agents as market shift. Poly and Kvote are examples of these. And then we have scalable backtesting and automation for retail and institutional users, for example, using Quant Connector. And they help us, do efficient data driven single signature AI agents that, replace manual signal generation. But there are potential risks and regulatory review is there. So potential for system amplification of volatility. These AI agents could trigger correlated trades across firms, and regulators like SEBI FCA are consulting on rules to govern AI and ML usage in algorithmic trading to uphold market integrity. So final thoughts are AI agents, like U-Trade Intelligence and Algo Bulls are democratizing algo trading by enabling retail traders to build and launch AI-powered strategies without coding. Globally, platforms such as Trade Ideas, Holly, Covout, and Quant Connect serve institutional and quant developers with scalable AI tools. And institutional quant firms, example Two Sigma, G Research, Volian, deploy proprietary AI agents at scale for high frequency system execution. Okay, so that's the AI agents, and how they help us. What are the key advantages of them, and what are the platforms in India, US, UK? What use cases are being used, and popular examples, and we have gone through. We have also went through each one of the example, what benefit it offers. So what we will do now is we'll add to this particular thing. So what we will do is we will go through how large firms like G Research and GSA Capital employ AI agents for predictive modeling and execution, and how normal retailers in India, US, and UK can employ AI agents for predictive modeling and execution. Okay. So how large firms like G Research, GSA Capital use AI agents? So AI agent is a software which uses AI. The backend is language learning models, and it does work automatically without human supervision. Okay, that's what an AI agent is. And this is the most happening thing right now, and its potential for use is there in pretty much every industry, and we are discussing about how this is being used in large firms like G Research and GSA Capital. Okay, yeah. So that it's used for primarily large firms use it for predictive modeling, and G Research uses advanced machine learning and AI models. So example is ensemble models. Ensemble models is a combination of different ML models like LSTM, SVM, and transformers. If you combine these three together, or any there are 10 to 11 ML or AI models. If you combine any of those uh, if you use a combination of them, that is called an ensemble model basically. So yeah, so these G Research uses advanced ML and AI models. Example, ensemble models, neural networks, and transformers. And they use these AI models and they train them on price action history, alternative data like social media data, news sentiment data, and satellite data, and macroeconomic factors. Okay, so they take these models, train it on data, price action data, historical data, alternative data, social media news data, macroeconomic factors data, and then this model outputs probabilities of asset movements, not just simple buy and sell labels. Okay, but it gives you the probability of that asset movement also. So that's the beauty of it. It tells you the probability, but this is the probability that this buy is going to happen. That's what also these models give as output. So that is how they use it for predictive modeling. The other thing that they use is automated execution also via AI agents. Okay, so AI agent can automatically execute the trades. So this AI agent's execution, they adjust the execution based on liquidity in the market, market volatility, and order book dynamics and news events via real-time NLP models. And these strategies are deployed in co-located servers so that latency is minimized. So automated execution is also done via AI agents, and the AI agents can automatically adjust the execution based on certain factors like liquidity, market volatility, news, and order book dynamics. And they're near the these are co-located servers near the exchange that reduces the latency. Yeah. So other than using the models, training them, and giving probabilities and buy and sell signals and automatic execution, AI agents doing, they also do continuous learning. So these firms, they use this AI agents or models, and they train them and retrain them daily and hourly. And these AI agents evolve to reinforcement learning. Reinforcement learning is a AI ML model. Okay, so they train these models hourly and daily, and these agents evolve to reinforcement learning from market environment outcomes. Okay. So continuous learning is also another thing they do. Infrastructure, so data lakes, custom ML pipelines, and real-time data feeds, internal AI assistants recommend new features or strategies, and they use heavy usage of Python, PyTorch, TensorFlow, Ray, and Slum cluster. So this is how the institutional firms use the AI agents. One is for prediction, predictive modeling. One is automated execution and continuous learning, and for infrastructure. Okay. Now, how coming to the retail traders, how they use can use AI agents. Even retail traders, without spending millions in infrastructure, they can also access AI trading agents through certain platforms and open source tools. Examples are You Trade Intelligence. It has something called as AI agent in Hindi and English. It's a retail AI agent for strategy suggestions, does back testing and deployment for you. Tradetron, it has a strategy engine with some ML automation. It's basically does no code algo trading platform with auto execution. Lars Algotech is there, retail focused ML engine, includes tools for AI based prediction and back testing. Sensible is there, option analytics and bot execution, suggests trades based on AI signals and executes via brokers. US and UK tools available are Trade Ideas, Poly. This is a built-in AI agent for trade ideas. It does real-time scanning and execution. Kavot K Score, it does predictive equity scoring with AI. It scores stocks based on patterns. Quant Connect, this does custom Python ML pipelines and backtests plus live trading via brokers. Turing Trader.ai, templates for AI agents in trading. Retail friendly, it has grown in open ecosystem. How retail traders can set up their own AI agent, without spending millions of dollars. They can collect data from, using APIs like Yahoo Finance, Alpha Vantage, or broker feeds like Zerodha Kite, IBKR, or Alpaca, and they can store that in CSV file or SQLite, and then they can train these predictive models with this data that they collected from Yahoo Finance or broker feeds or Alpha Vantage, and to this CSV file. They can start with a random forest ML model or XGBoost ML model or LSTM ML model or transformers like Finbert for sentiment and NLP. Yeah, so once they store the data that train the predictive models, they can build logic, AI agent logic. Like, if a model prediction is greater than threshold, then place the trade, otherwise hold the position. Such logic you can write, and then you can backtest, use backtrader, quant connect, or bt.py in Python, access sharp ratio drawdowns and accuracy. Okay, then execute these trades automatically. Connect to a broker API in India, Zerodha of stocks, and US UK, Alpaca, interactive brokers at TD Ameritrade, and use webhooks, Tradertron or Pine Connector, or custom bots to execute the trades automatically. Okay. So safety tips for retail AI agent usage is always paper trade before going live, and to see how the strategy is performing. Also backtest and see the backtest results. Limit the position sizing to avoid overfitting traps, and monitor for model drift as market conditions evolve. Example of AI agents in Indian options market are Finbert. You can use Finbert sentiment agent to analyze news for Nifty stocks, feed scores into a decision tree model to forecast direction, backtest with NSE intraday data via utrade or AlgoBulls, and execute via Connect API using your own code. So these are the examples of AI agents used in the Indian options market. So final thoughts, what is the difference between large funds and retailers in terms of AI agents? Large funds are JSA and G Research, and retail traders in India, US, UK. So data source is different. Okay, so large funds have proprietary and alternative data source, whereas retail traders only can use public APIs of Yahoo Finance, some broker data, and they can use the publicly available news and prices data. Model complexity also, large funds use deep learning and ensemble models they use, whereas retail traders can only use decision trees, XGBoost or LSTM models. Okay. Execution speed, large funds have microsecond latency, and co-location servers they have, whereas retail traders they use a broker APIs. It has 500 millisecond latency. Agent capability, large funds are fully autonomous, whereas retail traders agents are semi auto guided. Okay. Cost for large funds is a lot of dollars, but for retail traders it's pretty much with very less dollars with free tools. Okay, so that's the summary. So that's AI agents, how AI agents are being used by large institutional funds, how AI agents can be used by retail traders. What's the difference between their usage by institutional and funds as well as retail traders, and what use cases they are being used by institutional traders and retail traders. And also we went through all these AI agents, what are the popular ones in US, UK, and India, and what are the advantages of these AI agents, and we went through all the use cases also. Yeah, so that's it for today, guys. Thanks everyone, have a nice day, bye. Hey, hi everyone. Welcome to another video in our AI tools series. So today, what we will do is we will use ChatGPT itself, but we'll use the ChatGPT to convert a Gaussian channel. So Gaussian channel is an indicator in TradingView, and we will use ChatGPT to convert the Gaussian channel indicator into a strategy. So this same thing process can be used to convert any indicator to strategy using AI. So what we are discussing today is using AI tools to convert an indicator into a strategy. Okay, and asking the AI tool to write the Pine script code, acting as an expert script code developer. So the prompt I gave to ChatGPT is act as an expert Pine script code developer and use the Gaussian channel source code below. So I copied the entire Gaussian channel code from TradingView and gave it to it. And I asked it to create a strategy, and the strategy is to take a long position when the color of the Gaussian channel is green. Okay, and the candlestick has crossed above the Gaussian channel or above the middle line of the Gaussian channel, and take a sell position when the color of the Gaussian channel is red and the candlestick has closed below the Gaussian channel or below the middle line of the Gaussian channel. So this is an example. It's just for demonstration purposes, so it's not a strategy recommendation, okay, or a financial advice. Okay, so this is just a demonstration of how AI tool can be used to convert a particular trading view indicator into a strategy. Okay, and yeah, I'll just show you what a Gaussian channel is before we proceed. Okay, so this is my trading view, and yeah, it's taking time to load. So I just wanted to show you what that tool is, what indicator is, the Gaussian channel indicator. So yeah, my yeah. So this is the Gaussian channel. It's taking some time to load. Just give it some time. Uh, yeah. So this is a Nifty chart. Okay, and it's a 5 minute chart, and I have enabled the Gaussian channel for now. Okay, I don't know why the internet is slow today, but yeah, it's taking some time to load the charts. I just wanted to show you. So I have already developed this entire strategy, and I have an indicator also for this. I wanted to show you how the indicator looks first, then how to convert that indicator into strategy is what how we will use ChatGPT to do that is the thing that we will discuss in today's video. Yeah, this is taking a lot of time to load. Not sure. Yeah, so this is the Gaussian channel. So if you see, this is the Gaussian channel, and yeah. So what we had, so the Gaussian channel basically is, if it is, it will tell you, when not to trade, as well as when the market is bullish or bearish. So if the Gaussian channel is, so suppose, yeah, this one, let me make it as 15 minutes. So I'll make this as 15 minutes, so 5 minutes. Yeah. So see, so this is a Gaussian channel, and what it tells you is if it's green, then it's basically bullish. The market is bullish, and if it is red, the market is bearish. And if it goes above the Gaussian channel, then you can take a bullish trade, and if it goes below the Gaussian channel, you can take a bearish trade. And if it is within that channel, then generally it's a range bound market, and you don't trade. Okay, so that's what this Gaussian channel is. And what we are doing is we are using AI to convert this Gaussian channel, which is an indicator, into a strategy. And we will use this indicator code, which we have taken from source code of this particular indicator by taking a working copy. And then we have given certain instructions to ChatGPT. So we asked ChatGPT to act as an expert Pine script code developer and use this source code which is given of Gaussian channel, and to take a long position when the color is green and candlestick has closed above the Gaussian channel, and middle or above the middle line of the Gaussian channel, and the same sell position when the color is red and candlestick has closed below the channel or below the middle line. So this is what it is. So it has when I gave that prompt to it, it asked me to give the source code. I gave the source code to it from trading view, and then it has asked, it has given the code actually, and whatever I gave the filter for, it has generated the code for that. Okay, it has generated a code for that, and this is all the code that it has generated, ChatGPT has generated. Then yeah, and this is the strategy logic basically. Whenever the candle closes above the upper band or the middle line, we'll do a long entry, and when it closes below the lower band and the middle line, we'll take a short entry. And this is the code it has generated. So I copied this entire code and pasted it into the chat. I got some errors when I copied this code and pasted it into TradingView and executed it. Then what you can do is you can just paste those errors and ask it to fix. So it will automatically fix it for you. So I posted the error, it fixed it for me. I got another error, I posted it, and again it fixed it and gave me the final code. So this code was working fine. Okay, so that was the final code which was working fine. And yeah, and yeah, so we can use this AI tool. It even develop the code to take profit and stop loss, and the configurable profit and stop loss. We can a code that for that also has been generated by AI. Yeah, so this is the way we can you take any indicator in trading view and convert it into a particular strategy. So this is a Gaussian channel strategy which I have you know uh, basically developed using AI. And when I generate the report and test it on Nifty, uh, total P&L is from 1 to 3, right? 2023 to 2025, not sure. So let me take it to 2021, right? And then generate a report. Yeah, we have to do some adjustments, tweaking in the code, but it has a percentage of 94.7% profitability is there in this particular strategy, which is very high. I got a positive result. Not sure why it is negative now, but when I tested, it was positive. Let me just check. Yeah, I'm not sure, but it has a very good profitability ratio, which we can use. And this is how we can develop, use AI to convert the indicators to strategies. When you find such things, you need to tweak certain parameters so that, this P&L will be good. But profitability is very high here, 94.12%. Okay. Thanks everyone for joining the call. Have a nice day. Bye.